kind of dive right in. Let's dive right in and let's talk about the market and talk about where interest rates are at right now, right? I'm sure you guys have seen some stuff, heard some stuff, and let's talk about what we can do with that information. So, bond market has been pretty volatile the last week and a half, 2 weeks. Obviously, with the federal funds rate going up, the feds are hiking rates, and we all know that what the reason is that they're doing that, right? They're trying to slow down inflation. Inflation is the #1 enemy to mortgage rates. When inflation is high, interest rates also are going to go up. A simple way to kind of explain that to folks, or even for yourselves, and for me, is just, these mortgage bonds, right? These fixed rate loans that are given to people, those are bought, right, on the as a bond on the stock market, on the secondary market. And when the interest rate that's attached to those are an investment for investors, right? So if you're lending someone money at a 2% or 3% interest rate that's locked in for 30 years or 15 years or whatever they did, that's your rate of return as an investor, right? But if consumer price index comes out and inflation numbers and data comes out and shows that the cost of goods and all around the world, essentially, this isn't just a United States issue, it's a world issue with inflation. The UK is they're worse than us right now. But if the cost of goods and everything are going up to 8, 9, 10%, then the money you're lending out and the return you're getting and the cost of everything else is going up, you're not really making money, right? So that's why when these inflation numbers and inflation data started to come out, that was the Fed's response, was to, hey, we need to try and slow this inflation down, and interest rates went right up with it. Now, coming the next Fed hike, which is anticipated, there is going to be another one, will be November 2nd. The October inflation reading for October will be coming out on November 13th. And that is a pretty important date to where we might be able to start to see some relief potentially, if it shows that all of these rate hikes have made a dent in the inflation numbers, right? If that inflation number starts to come down, then you can start to see, hopefully, mortgage interest rates start to come down. There's actually a PCE number that comes out tomorrow. That is the exact definition of that is the personal consumption expenditures. So sort of similar to the CPI, kind of shows what money's being spent. But the market's already kind of embraced for that. They know that it's not going to be a good number based on August and September figures. So one of the reasons why we've already seen a sell-off in some of these mortgage bonds and seen interest rates go up, but potentially it could get a little rocky tomorrow as well. So, some of the advice is to lock in any clients today that you have on for their mortgage loans. Now, I know the question I've got a lot is, hey, where are rates at roughly right now? And I would say for a well-qualified borrower, so someone with pretty decent credit, a decent down payment, they're looking at somewhere in the high 6s with maybe a point or two of buy down costs. Okay. Now, that is going to do a few things for us, right? If interest rates continue to stay at this level or go up, a couple of days ago, we were looking at the 7. So we did get a little break right here at this bottom of this red candle here. This was on September 26th. I think I spoke to a few of you, maybe Chrissy as well. Where this day, mortgage rates at that, if we were locking someone in that day, they were getting 7.25%, 7%, 6.99. Now we've had a little bit of a bounce back, a little bit of a rebound the last few days that can kind of keep us out of that 7 range. But like I said, it's very volatile right now. We don't know exactly where it's going to go. Can rates continue to rise? Absolutely. What that will do, what you would think it would do, would slow demand a little bit, right? Some buyers that were even on the fence of putting an application in or looking at it, they're saying, hey, that's just too expensive. I can't afford that payment. And what happens if, buyer demand continues to wane a little bit. Homes sit a little bit longer, right? There's a little bit more inventory. And what happens when there's more inventory on the market and homes sit a little bit longer?
Prices come down.
Prices start to come down a little bit, right? And so what I feel is the best course of action for us to counter that, right? To be able to still get people into homes, because I want to be able to give you guys a solution. And this is the best thing that I can think of. And, you know, I spoke to a bunch of other loan officers at my company, and, you know, we had a couple powwows. And, you know, it's not fun, right? Quoting someone a 7% or 6.8 interest rate and, you know, seeing what that monthly payment looks like for them. But the flip side is if prices are coming down, or if sellers are potentially starting to get more and more desperate and willing to work with our buyers on terms. I know Ron's talked about that many a times on this weekly call that we do, that, hey, you know what? This is the opportunity for us to really get smoking deals and really good terms for our buyers. And so the program that to me is better than an adjustable rate mortgage. This is still a fixed rate. We've closed one of these with home buyers, is our Smooth Start program is what we label it, but it's essentially a buy down program where we utilize seller credit to kind of offset the monthly payment for the buyers within the first couple of years of the loan. And I want to show you guys kind of how that works. So the most common buy down will be a 2-1, which means that whatever their initial start rate was. So let me show you here kind of a basic. This would be I worked up a $500,000 loan amount, a 625 purchase price. So they're putting 20% down. I have them at a 6.875 rate. Now they're
Josh,
Yep.
quick question. Is this the one you told us about where you guys hold the money in-house and pay the difference on the mortgage payment?
Correct.
Okay.
I really want to go over this with you guys so that you can, I mean, obviously you don't need to go into depth. That's my job to talk to the clients about this, but I want you guys to understand from an offer standpoint, when you're structuring your offer and we're looking at properties that have maybe been sitting on the market for, I don't know, 2 weeks, a month, how we can really leverage the offer and figure out what price to offer and still be able to get some of this seller credit back if monthly payment is a main issue for the client, right? So, which most folks it is. And trust me, guys, I mean, I'm sure with the transactions that you've been doing these last few months, and I know that the majority of the buyers that I've been working with, even through your company and your team, we've been getting seller credit on almost every single purchase. So this is something I think is very obtainable and very reasonable, and could potentially save the seller money, where if they don't have to really drastically drop their purchase price, if there's kind of a middle ground where maybe they come down in price and we ask for a seller credit. So in this particular scenario, let's just go over a 2-1 buy down so you guys can see exactly how much seller credit would be needed. So essentially the first year of the loan, it's a 30-year fixed loan still. And the first year, their mortgage payment will be based off of a 4.875 as opposed to a 6.875. So the monthly payment on that would be subsidized essentially. And yes, Cedillo, this is where Summit Funding just essentially holds that seller credit. So the total amount of seller credit we would need for a 2-1 buy down in this particular loan amount scenario would be $11,586. So that's a little less than 2% of the purchase price if the purchase price is at 625, right? And for the first year, their monthly mortgage payment would be $638 less per month. So no one can get a 4.875 right now, right? On an adjustable loan, on a fixed rate mortgage. So the idea is that, hey, the first 12 months, you're getting a rate and a payment that you can't access anywhere in the mortgage world, in the lending world. The second year, if we don't have an opportunity within the next 12 months to refi you, right? You get the house you want, you get the terms you want, prices come down, you get some seller credit, really nice package for the buyer, right? If for some reason in the next 12 months, we can't refinance them into a lower overall fixed rate mortgage, then it goes to a 5.875 for that second year. And that's still $326 less on a monthly basis than their finalized rate, which if for some reason now, after the next 2 years, interest rates haven't come down, which I'll get into that in a second, which they should, then they lock in for that 6.8 for the remainder of their loan. So it's only $12,000 in this instance that we would need in seller credit on a $625,000 purchase, which I know you guys can work that and figure out how to make that work. So again, these are the times, these volatile times in the market where lender, realtor, we need to be working hand in hand, especially when it comes to presenting an offer, and we can figure these numbers out together if you'd like. I'm more than willing to help you guys with that. And it's going to take some communication with the listing agents, right? And you guys know how to do your job, you know how to do that. But I think this is very viable, and can still get people into homes at affordable payments, and not scare them out of the market, where I think in these next couple months are going to be some great buying opportunities. I know a lot of investors are kind of licking their chops, waiting for prices to come down, right? Now, there is another third option where you can really, really lower the rate, but it does take a lot more seller credit. So this would be a 3-2-1 buy down, where essentially their first year would be at a 3.875. So we're kind of taking a time machine back a little bit to last year, right? So 3.875 for the first 12 months of the loan, 4.875 for the second year, and then 5.875 for the third. Then the fourth year, they'd be locked in at that 6.875. Now, I know you guys have heard this and you've seen the charts, but we are technically, we are in a recession right now. There's been 2 consecutive quarters of a negative GDP, but they're moving the goalposts a little bit because this second quarter was just a little bit less, or barely a negative number. They're trying to say, hey, we need to see more evidence. Eventually, 6 months from now, they're going to look back and say, yeah, we're pretty much in a recession right now. But as you could see, anytime that there was a recession, a full-blown recession, mortgage rates will drop. And we might even see, if it gets too, volatile, we might even see the feds come back and either start to lower the federal fund rate, or maybe buy some mortgage-backed bonds again if things get a little too out of hand. But that is essentially what I feel the market's going to play out. I think it's going to be rocky for the next 3 to 6 months. But I do feel like in the next 12 to 24 months, anyone that's bought a home and had to lock in any rates in this time period will have opportunities to refinance and get that mortgage payment lower. And I say that with confidence. I mean, I would be very, very shocked if anyone took out a loan right now and couldn't refinance in the next year or two. Maybe it's even sooner than that. I mean, wishful thinking would be like, by March or April of next year. But I think that'd be that's pretty optimistic there. Anyone having any questions about this?
That's good information. So on the first one you were talking about, that one essentially is going to cost about $12,000?
Yes, on the 2-1 buy down in this particular scenario, it would be about $11,586. So it's an actual exact dollar amount. So I know a lot of times when we ask for seller credit, we sometimes just throw a percentage, right? Oh, can we get a 2% or a 3% seller credit? Which is fine if you guys can get more. In this particular scenario, Yolanda, let's say that you were able to negotiate a $15,000 seller credit. Well, then only 11 would be needed, a little over 11 would be needed for this program, and the remaining, 3,500 goes towards
closing costs,
fees and all that kind of stuff. Yep.
Okay. All right. Yeah, that's good information.
Wow. So I'm going to be presenting this to most, most buyers, and this is for someone that they do have to be qualified for a standard loan, right? This doesn't work for people that need down payment assistance or CalHAPA loans and things like that. But this is for someone that has at least a minimum down payment, a 3.5% to 5%. They have enough funds to cover closing costs for the most part. This would be an option for folks like that, which, in this market, that's pretty much who we're going to be working with. We could take a look at Cal Halfa's rates today. They should be a little bit better than where they were at yesterday. Let's see. So for that home equity builder loan that I've been promoting a lot, that's the 10% second mortgage that's forgivable after staying in the home for 5 years, which is a really great program. I really like it. We're starting to fit more and more people into it. That would be at a 6.75 on an FHA loan, and we could also do conventional loans with that as well. It'd be at a 6.625. So even a little bit slightly better than some of the standard conventional and FHA pricing right now. But yeah, any questions or comments or anything that you guys have been running into, whether it's rebuttals, you know, or any ideas of how we can kind of keep things afloat here during this kind of volatile market.
I have a quick question. So what is the probably like the max number we can ask for in credits?
In credits, that's a great question. So it depends on, for a conventional loan, it depends on how much money they're putting down. So if someone's putting down a minimum amount like 3 to 5%, the max is only 3%. On an FHA loan, the max is 6%. Now, if they are putting down 10 or more percent down on a conventional loan, then you can get up to 6%.
Okay, all right. So that's good always just to, like you said, run it by you first, right?
Yeah, oh yeah.
And confirm.
And confirm, and yep, absolutely. And you know, Yolanda, we've done that multiple times on especially some of the clients we've worked with recently. So yeah, I love it when we can just communicate, hey, let's run these numbers. And that's where it's going to take, right? We're going to have to just be really crossing our T's, dotting our I's. I mean, the one thing I know that can help keep business moving forward is more leads, right? If there's less demand or less qualified borrowers, that means we just have to find more, and we have to take up more of the market share, answer the phone more often, be more persistent on our callbacks and our follow-ups. You know, myself and Jessica and Ashley, my team, I mean, we're constantly, you know, reaching out to these leads, especially the internet ones, the Zillow ones. We legitimately give them a 6, 7, or 8 calls before we determine if, okay, these folks just aren't interested, or, you know, we're wasting our time calling them. So we stay pretty darn consistent with following up with folks, trying to get their application, getting them scheduled with me where we can do their loan consultation. And I think on your guys' end, that's just where it needs to be as well. Like, hey, be pretty darn persistent, set some time blocks throughout the week where, hey, for these 2 hours, these 3 hours, I'm gonna get on the phone and call people that have not gotten back to me, and try to do it at times where you think they might answer. I mean, the best time, in my opinion, in my career, whenever I needed to ramp things up a little bit, I would take a Saturday at, you know, 9:30, 10 o'clock, when most folks, okay, they're off work, they may have some time to talk on a Saturday, and at least get them on the phone, right? If you're having a client that's just during the week, they just do not return your voicemail, they don't call you back, they don't answer your texts, you know, try the weekends to do a power hour and try and get some folks on the line. What else was I going to go over with you guys here today? I think that was about it. I hope I covered, you know, enough.
I have a question.
Mm-hmm.
So what is your response? Because this is something I get all the time, and I want to get your perspective of those buyers that are kind of on the fence. They're like, yeah, rates are real high right now. And I'm just going to wait. I'm going to wait it out.
Well, for me, it's always, for us, we're always trying to get them to take an application, right? Where a lot of times they don't want to have their credit checked, or they're just, I don't really want to, I think I'm just going to wait. They don't want to go through the loan process. I think clients are maybe a little more, what you guys see, they might be a little more open to, yeah, let me go look at the home, right? And hopefully not waste your guys' time. But what I always go back to is, look, there's no pressure to do anything right now, right? All we want to do is get you the information that you need, so that if something this month or 3 months down the line or 4 months down the line, if an opportunity comes up, you are prepared and you potentially are approved to where you can take action to get into that home, right? Maybe a scenario comes up where it's a neighbor down the street that you know is selling and they don't want to put the house on the market, and they'd rather sell it to you because they worked with your mom for 10 years. There's all these scenarios that come up, right? So that's always my go-to is, look, no pressure. I understand that you might be a little hesitant, but let's give you all the information you need. Let's get you approved. Let's talk about your credit. Let's talk about your monthly payment, your down payment funds. There's tons of programs that are available to you. Right now, it's a great time for buyers because you can negotiate really, really beneficial terms. What does that mean? Oh, are you a first-time buyer? Yeah. Did you try buying last year? No. So if it's someone that's just completely green, then you kind of got to educate them, right? Well, a term is how we structure the offer that goes to the seller. And then you go through, hey, the last 2 years, it was completely a seller's market. And you can kind of talk to them about how people were having to overpay by $50,000, $100,000. And it was really, really a weak position for a buyer, but how much stronger it is now. And then from there, once I do go over the loan numbers with them, and let's say they're approved and they've got the information, 9 times out of 10, the dream becomes more of a reality, right? They're like, oh, wow, this is actually doable. And then it's just a matter of us finding them that right home. But to answer your question, that was a long version of the answer, but I always go back to, that's totally fine. There's no pressure for you to do anything right now, but you should be prepared, because once you talk to Josh, there may be some things with your credit, with your income. Maybe you are assuming that you can use the overtime income that you just started receiving because you worked at Tesla now and you're getting a ton of overtime income and you feel like you're making more money. But if your previous job, you didn't work any overtime income, you really can't use that, right? So a lot of times folks might think they have the information, they know where they're at, but without talking to a professional and really dialing it in and taking that 45 to an hour long conversation with me during our consultation, that can really give them the ammo they need. And then after that, I always say, and if you decide you still want to wait, hey, we'll just check in with you every other week or once a month,
Okay, yeah, that's good. And then one of the things that I always get, first of all, I always tell people it doesn't cost you anything, right? Because right away, I don't know if they think it costs money, but I'm like, it doesn't cost you anything other than some time. It
That's
costs
great.
you a little bit of time. That's it. I guess another question is, how does this impact, like running their credit? How does that impact their score? And does it impact their score?
You know what? It really doesn't. Unless you've had your credit ran and had legitimate hard inquiries ran multiple times, having a simple credit check is not going to impact it. And one of the things that I always explain to them is whatever they see on Credit Karma or whatever their bank gives them, those are different scoring models than an actual inquiry, hard inquiry from a mortgage lender where we pull all 3 bureaus. So whatever they may think the projected score is that Credit Karma gives them on a monthly basis, that's all it is a projection. It's not an actual, so they may think they have a certain credit score, but that may not even be it. Plus we pull from all 3, right? And we use the middle score to qualify their loan. So they may be getting a score from Credit Karma that shows them at a 650, but the other 2 bureaus are at a 710 and a 750. So yeah, I absolutely tell them it does not impact your score, which it doesn't. Because if you've never gotten your credit checked, then how do you know truly what your score is anyway, right?
Yeah. Okay. Thank you. That's good. Cause I like to just, that's what I thought, but I always like to have confidence and, now I have that confidence.
Yeah. I always just say, you know what, it only really hurts to have your credit checked if you do it excessively in a short amount of time. Like, yeah, if you're getting, you're buying a car and, sometimes the auto dealerships will try to approve you through multiple lenders, and you'll have multiple inquiries. Like that could drag down your score for sure. But just a simple credit check, even 1 or 2 by a mortgage lender within a month, you're fine. Absolutely fine. That's what it's there for. That's what the scores are there for, to be able to help get you financing,
Yeah. Cool. Thank you.
Yeah. Yeah. Katie, anything? I haven't talked to you in a while. Oh, you're muted, I think. Okay, no worries, no worries.
Hey,
I have a question,
Sure.
or I should say it's something that, so Edgar, who I sent over to you over the weekend, he just told me he wants to put his buying on hold right now because he says the market is just too crazy. He said it just seems the economy is going to go crazy. And then he was also wondering, with the hurricane in Florida, how much is that going to impact the economy?
Oh, I haven't heard that is like something that's going to move the economy or move mortgage rates or bonds or anything like that. I don't think that's an issue at all. I think the same kind of narrative. And when I am going to get a hold of Edgar and speak to him.
Oh, by the way, real quick, I don't mean to interrupt you, Josh.
Mm-hmm.
So he had a negative experience with a former lender, and I let everybody know, when I sent him over.
Mm-hmm.
Josh, he was blown away by your team, just their constant feedback, just the positivity, the professionalism. He had nothing but great things to say about you guys. I wanted to pass that along because what, bad news usually gets to us first, but it's nice to get good news. I just wanted to tell you he was very pleased.
Yeah, thank you very much. I think what I'm going to do once I do get him on the line, because I'm not gonna, like, that's not one I'm gonna just let off the hook. I mean, so to speak, where we just take that text. I think it was a text or something where he sent that in. It's like, no, we're gonna talk and we're gonna explain to you, about the market and really educate them, right? Like, we are the professionals here. We're in it daily, hourly, weekly. We're dealing with this stuff. So that's someone for sure that I'm gonna at least go over all the benefits and all the things that we spoke about, go over maybe the buy down program, or maybe he qualifies for some other assistance type of program, and at least give them the information, and then kind of get down to and relate to them and figure out truly what is the concern, right? Sometimes it can get down to an emotional response, or figure out kind of build that rapport a little bit. And then ultimately, if it comes to a point where it's like, okay, I still want to wait, okay, that's fine. We'll check in with you. And then we'll call him next week or the week after, or maybe there's some prices do start coming down, or he was looking at a certain home and we see a price reduction on that house, and it's a great.
That house checked all of his boxes, quote, end quote.
Yeah. So again, I know it's that cliche saying about, marry the house, date the rate, but I think that still is, it's still a valid thing. Homeownership, we're all huge advocates of it, right? Rent's not going down anytime soon. And anyone that takes a mortgage out right now isn't going to stay. That's going to be a short-term loan. Now, how short of it? Is it a year? Is it 2 years, 2.5? That's up for debate, but there's ways for us to work this stuff out, especially if we can utilize this buy down program. I mean, they really have, there's no rebuttal to that program if we can get it for them, in my opinion. Oh, that rate's too high. That payment's at 6.875 is too high. Okay, well, we can get you this payment. And an interest rate for the first year, 2 years, that isn't available right now.
Is Katie on the line?
Yeah, Katie's on here.
Katie, this would be a great script. The 2-1.
Yeah, Josh can write it up. No kidding.
I mean, guys,
Katie.
Real quick about the buy down. Is that only for primary, not investors, right?
correct.
Okay. I'm working with a bunch of investors and I'm like, guys, it keeps going up. You better hurry up and make a decision.
Right,
Okay.
right.
I can.
Well, you know what? Actually, let me double check that investment. I mean, I don't see why not. I mean, it's honestly all it is, guys. And it's and I want it. We all, as lenders, we want it to sound special. Obviously, like it's a special thing, but really, for the most part, I mean, there's certain circumstances where you can actually get more seller credit than what you normally would. Because remember, on a standard transaction, we can only use seller credit to cover closing costs, right? So if closing costs on a loan were $12,000, and that was, even with buying down points, that was the max that we had when we were, then that's all we could do. We can't use seller credit to leak over to down payment funds, right? So 12 is, if it was at 12, then that's the max seller credit we can use, even if you guys could get 20,000 from out of the seller. But in these scenarios, because of this program, it does allow you to go up, right? So if the transaction had a $12,000 closing cost limit, but we were doing the buy down program, they essentially get, and we needed 20,000 for that program, we could get that. And so it kind of like skirts that guideline a little bit. Oh, one other positive thing I want to talk about. So if they do the buy down program, and let's say they get, you guys are able to negotiate $15,000 for the program. Let's just use that number, right? And they end up refinancing within a year. And so they don't utilize all of that 15 to subsidize their payment over those 2-3 years. The remaining seller credit still is used. It goes back to them in the form of a principal balance reduction. So we give that back to the borrower, and let's say it's they have $8,000 remaining of that seller credit that wasn't used during their payments. Then that 8,000 goes towards their principal balance. So they still get that money. It's a truly a win-win for them. That does not get wasted or blown away.
That is good. So explain that one more time.
Well, so the way that the 2-1 program works is summit funding. We essentially, let's just say you're able to negotiate the 15,000 is needed to subsidize their payment over the next 3 years, right? What we do is we essentially hold on to that money. And then if their mortgage payment was, normally going to be $2,500 per month, but with the buy down program, the first year they were at $2,000 per month, then we would just throw $500 per month from that pot, right? From that escrow account, essentially. And so if rates were to drastically drop, let's say in the next year, where, we were quoting them a 6.8 and all of a sudden we can get back down to a, 5% or 4.75. And they're like, well, shoot, I want to refinance and get a 30-year fixed rate at that lower rate. Then if we hadn't used all of the 15,000 that you guys had negotiated, the remaining amount still goes back to the client in the form of a principal reduction on their loan amount. Does that make sense? So if they owed, if they took out a loan for $400,000 initially, so that money basically just doesn't go to waste. It doesn't just like, oh, I didn't use all of my seller credit, or I didn't use all the credit for my buy down. It still comes back to them.
Okay. All right. Yeah, no, that's good.
Because
and
that's
this is called this is the 2-in-1 program.
2-1 buy down. We do the 3-2-1 buy down, the 2-1 buy down. And just, for simple math, it knocks off 2% off of your start rate, whatever the current going rate is. So in this case, it was a 6.875, but the first year your loan is at a 4.875 payment, which is way, and a lot of people have asked about, oh, could we do adjustable rate mortgages? Adjustable rates are still in the 6s, right? So at least you have a 30-year fixed loan with a reduced payment for those first 2 years. And then the narrative and the sales pitch essentially is you are going to be able to refi out of that 6.8 within hopefully a year or two.
But Josh, this is exclusively through Summit, right? This is a program that you guys offer only?
Mm-hmm. Well, I don't know if, to be honest, I think I can't say that for certain if no other lenders offer it, but I don't think there's very many if there is. Yeah, Summit's the only one that offers it, so so that should be the answer, right? Sometimes I'm too hot. No, I don't know. Yeah, but I know that I don't hear about it a lot, and honestly, I haven't heard it from any other lenders. But honestly, I don't talk to too many other lenders in our industry, and we're kind of focused on you guys.
Yeah, I don't use that many other lenders either, but the couple that I have, because of the Spanish speaking purposes, again, they are not. They have no clue about this. So I mean, that's why I always go to you. You need to learn Spanish, Josh.
I know. Ashley's setting me up with a course to take, or she's got something dialed in for me, my assistant, so we're good. And she's gonna start speaking Spanish to me in the office as well. So I learn through a course, or else I'm not gonna know the lead update for your guys' leads. I have to learn it.
Yes.
All right, guys. Well, you know what? If you guys ever have any questions or scenarios that you want to, sidebar, email me, text me, call me. We could set up an appointment, even if it's a 10 or 15-minute call. I'm super available for that. I appreciate you guys hopping on here. Hopefully I gave you some good information.